Hello, I'm Adam Grimes, and I want to talk to you today about a trading pattern that I see here in corn. And of course, the danger of live market analysis is that this could look really dumb by the time you see it. If you see this a few weeks or even a few years later, you might look at the resolution of the pattern and say it was completely wrong, and it may very well be completely wrong. But this is an idea. These are all ideas that if you apply them consistently over a large set of trades, there is a significant edge. And it's also worth thinking about corn, and I'll tell you one of the reasons that I'm a little hesitant to do a video on grains here is because of the current geopolitical environment, and that relates directly to the risk in the trade. Do these things matter? Can you just take the trade in a vacuum? Well, I think risk always matters. And I think, again, if you're listening to this years down the road, you may have forgotten we're currently embroiled in a serious trade dispute / maybe really trade war with most of the rest of the world, and particularly with China. And President Trump is navigating this trade war with frequent tweets. So that's one thing you need to realize, that you have a very easy way for new information to get to the market, and the market will take that potentially quite seriously. If you imagine a situation, so either there are tariffs and reciprocal tariffs, and that has depressed the price of grains in the U.S., particularly soybeans. It's definitely had an impact on corn and wheat too, and you can see from the monthly continuous chart, corn's been on a pretty substantial downtrend. It's not too hard to imagine a situation where something comes out and everybody thinks, or in fact, all the trade dispute is resolved. Some agreement is reached. What do you think is going to happen to grain prices under that scenario? They're going to explode to the upside. Now, if you're short, that obviously is risk. And true, markets today trade pretty much 24 hours. Grains are less 24 hours than, say, bond futures or index futures, and there's, in almost all markets, there's a little time period when they're closed. And there's also, to my thinking, significant risk over the weekend. If you have this trade on and the market's closed over the weekend, there's nothing you can do. Should corn open 20% higher, there's no way you can get out of that. So you just need to be aware of that in terms of risk. And anytime you put on a trade in any instrument, you want to think about, how does it trade? Does this thing trade continuously on the chart? Are there a lot of gaps? Is it, for instance, are we in the US and you're trading an ADR, you're trading stocks that are domiciled someplace else, so their main trading activities outside of the US? Is it a futures market that is big and liquid? Is it a futures market that's thin? Is it a futures market that has some potential news event? And that's the situation here. So yeah, I just spent 3 minutes talking about risk that might seem kind of abstract, but when you put money on it, it's not so abstract. So the trade is a short. Now, those of you who know my work know that typically what I will like to do is, I'll just kind of draw here in the middle of the screen. If I'm looking to short, I want to see pretty good downward momentum, and then I want to see a kind of reluctant bounce, and then what we will look for is probably waiting for the momentum to turn, but looking for the second leg. So this is what we're playing for, and it's set up with kind of this 1, 2, 3, if you want to think about it in a checklist. 1 being the strong momentum down, 2 being the little bit of a bounce, which is a pullback or a flag, and then 3 being the turn of momentum into the intended trade direction. That is a pretty good recipe for trading pullbacks on all markets, all time frames, and not even just trading pullbacks, but being able to trade within the trend structure. Pretty good guidelines. Now, the question is, how do you define each piece of this? And we don't have time for me to ramble for hours about that, but one of the best ways that we usually like to use is the Keltner channels. If we have a market that can make its way to the Keltner channel, we can then usually often, or very often at least, look to trade a pullback, whether to the upside. So the market engages the upper Keltner channel here. You kind of go into the mode where you're looking to trade pullbacks to the upside. Here, I'd argue it's probably not enough, but the market did touch the lower Keltner, so maybe we look for shorts. And this is, in this particular case, the market's in mean reverting mode, bouncing back and forth between the Keltners, but clear momentum to one side of the Keltner channel will very often show when we moved into a trend mode. Now, I mentioned that because that is not what's happening here. Those of you who know my work very well will say, well, wait a minute. Why are you shorting when you have a higher low? So clearly, right, market's in a downtrend here. And clearly this is not quite as much momentum, right? So why would we be interested in taking a trade at a place where the market looks like it's losing momentum? Well, here's what's interesting. So I think there's two pieces of this. One, we do have a long bear flag of some kind. Maybe it's clearer on the weekly. It's actually the first substantial pullback on the weekly. We did have strong momentum down out of that flag here. And now you have a small flag. This is what I've called a nested flag. And I know the terminology is not great, but the concept is you have a flag that begins to break down and it has a little pause. This little pause might be another flag as it is here. It might just be a few bars sideways, might be a few bars with an inside bar. But I found this to be, particularly on daily charts, it wasn't something, I didn't think about this when I was really focused on intraday trading a decade plus ago. So there's probably validity there, but particularly on daily charts, really great pattern. Anytime you can find that little pause, once the breakdown of a bigger pattern has started, that can be a very good entry. And so that's the case here. Then, of course, you have to think about your profit target and stops and risk and everything. But if you can get the direction, if you can get the context of the trade right, it's a pretty good first step. That's all I have for you today. Thank you very much. If you want to see more of my work, best place to find me is at my blog, adamhgrimes.com. You also can follow me on Twitter at adamhgrimes.